Okay, this is problem 1711, dealing with M&M, proposition number 1. Excuse me. Miller and Modigliani, I believe that's how you pronounce them, famous financial theorists from back in the 60s and 70s. And although their theories are been on the books for several decades now, they're still accepted and widely used. But let's talk big picture. Their proposition number 1 says that the value of a firm, meaning the whole business, sometimes that's referred to as enterprise value, business value, firm value. Those are all used interchangeably, which makes things confusing. But the value of the whole business is solely a function of the future cash flows of the business, discounted to present value. That it doesn't matter how you finance the firm. That's just, financing it is just dividing up the value into different pieces of pie, sort of like cherry pie and blueberry, slice of the cherry, slice of the blueberry. But the total size of the pie, the total value of the firm doesn't change. You can carve it up in a lot of different ways, but the total size of the pie or value of the firm doesn't change. That's distinguished from equity value and debt value, because equity value is the portion of the total value of the firm that accrues to the benefit of the equity holders, the stockholders, or the owners. Those are all sort of equivalent terms. And the debt value, by the same token, is the portion of the value of the firm that's accrues to debt holders, people that have loaned the company money. So, main thing to remember is total value of the firm, according to their proposition number 1, never changes as a result of changing the financing. So mathematically, you've got a constant there that you can always use to make calculations with. So here, let's get into this problem. This company, Executive Chalk, is financed solely by common stock and has 25 million shares outstanding at a market price of $10 per share. So that means the firm value must be, since it's solely financed by common stock, $10 per share times 25 million shares equals $250 million firm value. So that's our constant, at least according to this proposition, which has a lot of simplifying assumptions, which we can discuss later, that may not apply in the real world. But for their theory, that number is going to stay the same no matter how much debt we issue, equity we issue. So let's say they intend to issue $160 million of debt. And I think the assumption here is that that's going to be the market value because it's newly issued, so they can't sell it unless it's valued at market value, and use the proceeds to buy back common stock. Well, knowing the total value is going to remain at $250 million, and knowing that if they do this, there's going to be $60 million of debt value, then the total value of the common stock is going to drop to 90 million, or the equity, in order for that to add up to be 250 million. So this first one, how's the market price of the stock affected by the announcement? Well, while the total value of the equity drops by from 250 million to 90 million, the market price of the stock, and by price that infers a per share value, not total value, a per share value. The per share value that should also not change, because there's the value of the $160 million value of stock repurchased reduces the number of shares by the same amount as it reduces the market value of the equity. So we could do a little calculation here. So say they buy back 160 million, $10, so they buy back 16 million shares. So after this deal is completed, if they do it, you've got 25 million less 16 million, you've got 9 million shares outstanding. And by proposition number one, it's $90 million, so $90 million divided by 9 million shares equals $10 per share. So, in theory, using the M&M proposition number one, there's no change in the per share value. Now, in real world, there are transaction costs, there are tax implications. Debt, the interest on debt's tax deductible, dividends aren't. And then there's just psychology of investors. You know, the assumption is completely rational investors. Well, investors aren't necessarily completely rational. They may look at this and try to infer, well, why is management doing this? Maybe if management are shareholders, they know something good because they're trying to buy back shares from other people, which will increase their shareholding. And maybe that means they know something good's going to happen that the market as a whole doesn't know. But again, this is theoretical. Everyone's got the same information. Everybody's totally rational. And so the market price of the stock shouldn't change. Price per share. Total value of the equity changes, but not the price per share. How many shares can a company buy back? Well, we just did that calculation with $160 million at $10 a share. They can buy back 16 million shares. What's the market value of the firm? Equity plus debt after a change in capital structure. It's okay. I didn't quite finish this this problem, so sorry for the break in the video. I think I learned when my phone rings and I silence it, it stops the video. So in the future, I'll put my phone on Do Not Disturb. But at any rate, so back to 1711, just finish it out. We covered the total market value of the equity decreases as a result of the announcement, but the price per share doesn't change, so because there's fewer shares, and the price per share doesn't change. We covered that. The firm value doesn't change. That's the whole idea of this proposition number one. It's just how that value split between equity and debt changes. The debt ratio, that's just the ratio of the market value of debt to the market value of equity. And so we know from up here, we have $160 million of debt that was issued, where the company had no debt before this new $160 million was issued. The $160 million, that must be the fair market value of the debt, or they wouldn't have been able to sell it. And we know that the value of the equity after this transaction is $90 million. So you just take the ratio of those two. And this can get a little tricky in some balance sheets. You'll see there's historical cost used for the value of equity in particular, also debt, but equity in particular, which may not reflect the market value of the equity or the debt. And I believe they always want you to use the market values for this calculation. And who, if anyone, gains or loses in this particular situation? Really, no one gained or lost. The stock price stayed the same. There's new debt holders. That was sold at market value, so they must be happy with it, or they wouldn't have bought the debt. There's some argument here that the equity holders have a riskier, they're each share of common stock has a greater degree of risk associated with it now because there's more debt and higher in the capital structure that gets their return before the equity holders do, whereas previously the equity there was nobody ahead of them, so to speak, in payment priority. But according to their proposition number one, M&M proposition number one, that all gets accounted for, so that there is, although there is more risk here, the market should value it the same because there should be also a little bit more upside since the company is levered. That's leverage always, from the perspective of an equity holder, is bad if something goes poorly with the company, but it's normally a good thing if things go well because there's fewer people that own the equity of the company. So if things go really well, the company does great, you potentially have more upside. So that should be accounted for in the fact that the stock price per share has not changed. Rather, the increase in risk is accounted for by compensating increase in potential return, or at least that's the proposition here by Miller and Modigliani for their proposition number one. Okay, that's all for 1711.